Much. Good evening, everyone. It's nice to see you. It's been a turbulent few months with everything that has been going on, both in the press and also with what has been happening with interest rates and the CCCFA. And tonight, what I'd like to be able to do is just take you on a little journey, if you like, in a quiet way. And we did this through through COVID. We looked at what was happening, and there was a lot of uncertainty around what was going on in the market, and of course, what has been said in the press. And so it's very important to have a look at this and view it really in a way that we can stand back and look at it by reviewing what has happened in the past and where we are today. So that is that for us is what we want to achieve this evening. First of all, let's look at why we invest in property. Well, of course, the wealthy have always invested in property. It's about the fact that they understand this concept of using other people's money. And that's something that we as a country, and I know with my parents and how they felt as typical New Zealanders about debt. But there is good debt and there is bad debt, as we all know. The difference is how we use that. So what are the reasons that most people have to invest? Obviously, to have a passive income in the future. But for so many of our clients, it's also about the fact that they have a mortgage. And most people will spend 20, 30 years paying off a mortgage. At the moment, we're seeing the stats are that about a third of New Zealanders will have a mortgage when they retire. Now, of course, over the last few years, as interest rates have increased, property prices have increased as well, we're going to see that, I believe, increase quite significantly. So one of the main goals of Propellor is to reduce your mortgage. And for most of us, there are only one way in which we can do it, because for most of us, when it comes to the options we have, we may have money in the bank. Now, money in the bank, even with interest rates going as they are, could maybe get you 2%. So $1 million, even 2.5%, that's 25,000. That's taxed. And of course, what we've got then is the fact that money isn't inflation proof. So what you can buy today with $1 million, you're not going to buy the same thing in 10 years' time or even 5 years' time. So always good to have money in the bank, but for most of us, that isn't an option, as we've bought homes, brought up children, and paying our mortgage. We're also seeing that KiwiSaver and lately, we've had a lot of clients that have seen their KiwiSaver decline, and it's actually heartbreaking when you see those figures go down and go down. Now, once again, always good to have KiwiSaver and to have other forms of investment. But when we're looking at a passive income in the future or paying off the average mortgage, and let's just say in Auckland or $500,000 to $700,000, it's just not going to cut this for you. And whilst you're spending those years paying off that mortgage, it's very difficult to put your head above the parapet to see any other form of investment. Stocks and shares, they've had their ups and downs as well. But with stocks and shares and money in the bank, it's a catch-22, because for both of those forms of saving or investment, it means you've got to have cash. You've got to have a significant amount of cash. And for most of us, what we have as currency, more than anything else, is equity in our home, and there's only one thing that you can use equity in your home for, and that's for property. And I just wanted to give you an example. This is something that we've been showing clients lately, and it's been a bit of an eye-opener, I've got to say, and that is the sorted. It's on Sorted, so please go and have a look at it. But this is a mortgage calculator that can tell you, with the mortgage that you're paying at the moment, how long it's going to take you to pay it off, and in fact, how much it's going to cost you through the banks with interest. So James, if at all possible, can you just bring up an example of the Sorted application? So here we've got it. So we've used a $700,000 loan, and obviously it's mainly for Aucklanders, but it doesn't matter, because even if you're on a $400,000 mortgage, the figures are going to really surprise and shock you, actually. So we've looked at an interest rate at 4.25%. Now, for most oh, I think, James, that someone can't see that. Can everyone see this? The repayments on this are $4,335 per month. And that means that over 20 years, you'll pay over $1 million. Now they can see it. Thank you for that. So that's over $1 million, and it's still going to take you 20 years in which to pay that off. So James, if you go a bit further up, we can also see, up. So what that interest is over 20 years. So you've got a $700,000 mortgage. You're paying this amount of money per month, which is not insignificant in repayments. The total that you're going to repay is over $1 million. So you've got interest of $340,000. And so over 20 years, you'll pay nearly 1.5 times that loan. So that's something to look at and think about when we say to ourselves, how can we pay this off faster? And then how can we look at a passive income? Because that is what is going to hold most people back. So let's move on from that. Because if we're now saying that property is, for most of us, the only option that we have to achieve having our mortgage paid off or to have a passive income, we've got to look at what the situation is today. Now, of course, in the press, I mean, it's very confusing, because a lot of it is headlines and clickbait. So you've got the fact that property prices have gone down on the front page of online or on the newspaper, and then further in, you've got the stats that says in May and June, property prices have gone up and there's been more sales. This is where we take a breath, and we've got to look at history. We've got to look at what has been in the past to be able to understand the present and also the future. So let's look at the last 30, 40 years even. Actually, yes, it goes back. I mean, it's frightening. So let's look at the 1980s, for example. So at the moment, there is all of this, this feeling that interest rates will go up again, and they probably will, but we'll talk about our view on them coming down a little bit later. But even if they're at 5%, it is significant compared to the 2% and the 2.5% that we've had for the last couple of years. But if you're my age and you have bought property in the 80s, you'll know that, for instance, in the 80s, we had interest rates of 21%. Now, that is from a bank. That's not from a second-tier lender. That's from a bank. And so in the late 80s, I had a mortgage of $750,000 at 21%. Now, that didn't stop people buying houses. Okay, the prices weren't as high, but actually, if you do your sums, what you're paying out can be a lot higher. So you've got interest rates that are very high. Then what we had in the late 80s, we had the stock market crash. And so property went down, the value of property. And then, of course, within 12 to 18 months, 14 months, property prices then went up and the market adjusted itself. So there was that recovery. Then we look in the 2000s, in 2009. Now, I started Propellor in 2009, and the interest rates were 9.7%, almost 10%. So that did not stop my clients coming to us and purchasing investment property. Why? Because there was no other option for them to do these two things, which is pay off their home loan, their mortgage faster, or get a passive income, especially if they didn't have the sort of money in the bank that was going to give them the ability to get that passive income. And let's understand that, as we said, cash is not inflation proof. So we've had people that have come to us, clients that have come to us that have won the lotto, for instance. They paid off their home mortgage, paid off the mortgages of their children, and then they were left, in one instance, with about $980,000 or $990,000. They were still only getting 2.5% to 3% from the bank. So they then went to a financial advisor. And at the end of that year, they saw that his fees were more than what they were actually getting from the funds that they'd invested in. And that's when they came and they spoke to us. Now, there's no way that we would ever use their whole 980,000 or whatever it was. But we put a deposit on 2 investment properties, 20% deposit on 2 properties at about 500,000 in those days, which were a house and land, which was fantastic. You can't get that now. And so they were cash flow positive through that. And basically, we were looking at only using at 500,000 a 20% deposit. So that's 100,000, 200,000 of that 900,000. So they started to get an income, which was more than they had previously when they left the money in the bank. And of course, those properties were going up in value, so that they had they were keeping up with inflation. Now, that's really important because we know that inflation is an issue today, and we're seeing it in food, we're seeing it in a lot of costs. And how do we keep up with that level of inflation? And that's where we come back to property. So now let's look at 2019, 2020. That's when we've had COVID. Now, through that time, once again, there was a lot of, and I won't say panic, but we had a lot of people come to us and say, what do we do? We've got, it was not just investors, but it was homeowners. So we started a helpline and we put out literature which talked about how we could keep mortgages going whilst there was uncertainty around employment and whilst there was people that were no longer employed. The point was that once again, what we saw was that the property didn't go down as we thought it was going to go down. And in fact, when Tony and Alexander and myself, and I don't know whether you know Tony Alexander, ex-economist, chief economist of the BNZ, both of us believed, because we were on the ground and we saw that the chronic demand for property that there was as far as housing was concerned, social housing, what was being built, what the demand was in the major areas in New Zealand, that property could not go down because of the fact that the prices of land was going up. rents were going up and the demand was going up, and we were proved correct. And so, yes, we have enjoyed lower interest rates today, but we have to look at the past and say, well, great that that has happened, but that doesn't take away from the fact that there is still, for most of us, only one way in which we can get to the next stage in our lives or pay off our mortgages, and that's through investment property. Because the one thing that's happened over the last 3, 4, 5 years is that, you know, the positive part of this is that we've now seen that 30% growth in Auckland, 20% in Christchurch, 27% in Hamilton. And so it's given most New Zealanders the equity to now be able to use that to leverage into an investment property. So we go back to the fact that for 30% growth has been fantastic. It has achieved a lot for us that have property. But we also, and please forgive me, that's my dog with a toy. This is so unprofessional. But going back to the 1991, 1992, we don't look at that 30%. We don't even look at that 27%, even though that's what's been happening in the likes of Christchurch. Still, that hasn't gone down, nor in Hamilton. But if we look across the country, as Tony Alexander was saying in one of his recent articles, we have seen a 7% growth year on year. So that means that property has doubled every 10 years. Now, in the cash flows that Propellor puts together and produces for our clients, we don't show property doubling for 12 years. And we also show worst case scenarios. So it is wonderful that we've had 30% growth or 27% growth. And so if in Auckland that's gone down by 10% from 30 to 20%, it's still going to give us property that is going to double over that 10 to 12 years. And if you don't feel comfortable with that, we will show you what is happening with property if it doesn't double for 15 or even 20 years. But let's look at why property is going to continue to go up. Now, we focus at Propellor on brand new property. So I'm going to give you brand new property as my example, why the cost of property in New Zealand, brand new property, can't go down. Let's look at land costs for a start. A year ago, I was recommending, and my team was recommending, house and land packages in Rolleston and in Outer Christchurch. At that stage, a 200 square metre piece of land was about $200,000. Now, within 8 months to in less, it's now up to $500,000 plus if you can get the land. And then, of course, you've got the build. Now, a lot of figures have been quoted, but with all of the developers that we're talking to, whether in Auckland, Christchurch, Hamilton, or Wellington, we're seeing increases in costs of building going up by 20 to 21% per annum. And that's to do with, first of all, a lot of the materials come from overseas. We know that there's been a shortage of jib, and that's because there's been one company that has had the monopoly on that. But if you look at steel, you look at other materials, they come in from overseas, and of course we have no control of this. And if we are concerned about inflation in New Zealand being at 6.5%, 7%, just think about the UK, where we're looking at 9 to 12%. Now, in China with steel, we have no control over what is happening in those regions. And the ability to get those materials in on time. We've also got a major shortage of suppliers as builders, electricians. all of those areas where a building needs to have contractors. So we've got a shortage. In fact, we've got a shortage of employment across the country. I can't tell you how long it's taken a number of companies that I'm involved in to actually just get employees into that company. So we've got the cost of building, we've got the shortage of materials, we've got the shortage of the contractors to actually put these together. So therefore we're seeing major delays. We're also seeing the banks now that have tightened up with developers. So with some of the developers that we're working with, they're getting their financing from Australia, for instance, and second tiers in Australia. And the reason is that banks in New Zealand at the moment are very concerned about the cost blowing out for a developer. As the build progresses, have they put enough into their budgets that's going to cover the costs throughout the build. And that's one of the reasons why we've got a situation at the moment that is for investors or for people that are buying off the plan, we've got a big issue with the clauses that are now being put into contracts that allow the developer to claw back some of those costs, and we'll talk about that a little bit later, and how we as a company counter that for our clients. So we've got developers that are going under. We're seeing this in Australia as well. So we're not getting the levels of development that we should be getting. Now, before COVID, you look at Auckland, there was a demand for 20,000 dwellings in Auckland before COVID. By the time that the banks tightened up and the prices increased in building, we then saw that there was 15,000 dwellings that were going to be built over a 5-year period, which went down to 12,000, and that's also reduced. And that was over a 5-year period. So you can imagine what that's like now. Then we look at the fact that we've got 180,000 emergency or fast applications for immigration into New Zealand. We've also got a chronic need for social housing. That's one of the things that we want to address as a company working with developers, but that's not going to go away for a long time. And so even though the borders are only starting to open now, what we're seeing is that rents are going up as the demand is going up. And we go back to, for instance, in Christchurch, when we have our house and land that are ready to be, that are finished, we have groups of families trying to get into those properties. And we have waiting lists for properties as they get built. So we've got someone that has a question.
Hi, Nikki. Yeah, we've got a question from Barry saying, saw Infometrics released a report saying 3.1% capital growth per year for the next 25 years. What makes you confident this may not be right and it'll all be 6.5% from Barry?
Right. Well, Barry, I come back to what we're saying about the supply and demand of property at the moment. We don't have enough property. The cost of building is going to continue to go up. We've also got the fact that even though there's a shortage of employment and finding people to work in New Zealand, what it's meant is that we've also got a lot of so people that are employed, it's solid employment. So there is a feeling that of feeling comfortable, and it means that more people then will look at purchasing property. And remember, this is at that 5% or 4.5% or 5.5%, as opposed to the 9.7% or the 21%. So as there's job security, more people, even though there's higher interest rates, will look at, and this is what history has shown us, that they will look at investing or buying into their own homes. So if we've got a shortage now and we've got less property that's being built because we've got developers that just can't get the finance, and we're looking at the number of properties, of brand new properties going down, we're going to see that increase. So even if you think about it this way, property is a commodity. As if we've got inflation of 6% at the moment here, that's because we've got goods and services going up by 6%, 6 to 7% at the moment. So what does that mean for property when we're seeing a higher inflationary, what we're seeing with the cost of materials going up by even higher than that 6%. Now, so if we had inflation of 2 and 3%, and we were still seeing property go up by 6 to 6.5%, before that, what is that going to be like now when we've got goods and services that are now at going up by that 6 and 7%? So one of the things as well is that, yes, we'll have migration. There are going to be New Zealanders that leave. But of course, what we saw through COVID, and I think we'll start to see again, is that there's going to be, I mean, it is an attractive place to live. We've all been locked down and it's been a bit draconian, I've got to say, and that's why we're all heading off on holiday to go somewhere else. But the reality is that we've, in Europe, we've got 40-degree heat, and we're talking about seeing the results of the temperatures rising around the world. We've got the war with Ukraine, and of course there is talk about what is going to be happening in China and how that affects the rest of the world. So there is a school of thought that is very much about New Zealand, about people still finding New Zealand as a great option. Now, they come into Auckland, and Auckland is our most dynamic city, but they also go to Christchurch. We've seen a lot of Aucklanders actually go to Christchurch, and we're also seeing Hamilton, and a lot going to Hamilton. So that's what I was saying about putting those interest rates into context, and why property is still incredibly relevant today, as it's always been. Now, what I'd like to do, because I don't want it all to be about me, is let's bring in and let's talk about interest rates, where they are now and where they can possibly go in the future. Now, my view is, just once again, looking at history, what we've seen is that when there's inflation, and obviously with the OCR going up, and we're seeing because the cost of living is going up, we've got interest rates that go up. So what is happening is that our spending is reducing as we're paying off our mortgage, but it goes in cycles. So as the inflation starts to even out again, that's when we will see a reduction in interest rates. And we're already starting to see that. So let me please introduce Brenda Murney, who is, she's been working with us in Propellor for the last, I think it's the last 12 years, isn't it, Brenda?
Yeah, I think it is that long, yes.
Brenda is number 2 in the South Island and one of the top mortgage brokers in New Zealand. Brenda's with Vega Lend, and not only do we recommend her to our clients, as we have done for over 12 years, but also her ability to go to more banks than most mortgage brokers to get the right deal for our clients. So, Brenda, I just sort of thought, if you wouldn't mind just going over where we are with interest rates today and where you see them going in the future.
Great, thanks, Nikki. Hi, everyone. Yeah, I think a wee while ago, Tony Alexander, who's one of the economists in New Zealand, he, one of our top economists, he and also you, Nikki, both sort of said that, you know, interest rates are probably going to come down middle of next year. Mid-23 is when they sort of had sort of forecast rates might come down again. So probably fixing for a year is a good option. And Tony Alexander also just posted last week, that he feels that interest rates could actually be at a peak. And that we may not need to see the OCR increase to 4% to be able to get inflation under control. So hopefully that'd be great if rates aren't going to rise much more, but you know, it does, you know, there is economists out there that are saying that rates may not increase much more than they are at the moment. So I asked Tony Alexander as well, I said, what do you think rates are going to drop to? What are we going to see them start with? And he seemed to think that they could start with a 3 again. So that would be great for all of us if that was the case, to have our mortgages with 3. A lot of people are coming off 2% loans still. And you know, rates today are well in the 5%. So right in that range. So if they start with a 3, we'll all be very happy. I can just talk a little bit more about interest rates and what they are currently. James, did you want to put that slide on for me? Yeah, so there's a bit of a variance in bank rates at the moment. There is some new build special deals around. Currently, that rate is 3.58%, and you can see that that's a lot lower than some of the fixed rates on offer. I've listed a few fixed rates. I just went shorter term, sort of 1 to 2 years, only because of what economists are sort of saying that rates may come down again. So I didn't show the long term, but they basically go right up to about 5.99% for 5 years. There is quite a variance with the banks, and not everyone has a choice about which main bank to go to, but you know, most property investors that Propellor deal with would be at the main banks, and there is quite a variance, as I say, between them. Some approve a lot more than others, so you know, I just think any main bank is a great option for people. Last week I got one bank offer a 2% cash contribution for the amount of the new build loan, which is really good. So that's, you know, that can be sort of $13,000-$15,000, which can certainly help cover costs and you know, any negative cash flow for quite a, you know, for at least a good year or so. So, you know, that's really good to see. But there is a huge variance between the banks and what they can offer at the moment. And I really try and look at all the options for everybody, look at which banks can offer what, give you the options, and I really try at your own bank, because I know it's a bit of a pain changing, at your own bank to get the very best deal for you at that bank. I've also just mentioned further down, you can see that rate, Pepper Money, they're a non-bank lender, and their rates are from about 5.29%. Non-banks will look at lending, you know, potentially 80% on all investment properties, but, you know, that is a floating rate. So as the OCR goes up, that rate will go up as well. New build deposits are generally, they're just 20%. So that makes quite a difference. If you were buying the house down the road with an existing home, the deposit requirement is 40% at main banks. So there is quite a difference and an attractive about the new build deposit. What else was I going to mention? So I was just going to cover off a little bit more about bank criteria. Like, for example, a house and land package compared to a turnkey purchase, meaning the turnkey just put down 10% deposit and then pay nothing till the end. That is much easier to get approved than like a section and a build, making progress payments. The banks feel they're not really locked in, so they are more difficult to get. So a lot of investors do choose to go down that turnkey path where it's just a deposit, doesn't matter how long the build takes, you then just pay at the end once it's built. So it does seem a lot cheaper and safer. But yeah, it's something to think about. The servicing is just so different. Other things to consider, with good investment property options are, small apartments are probably, more risky. Some studio type properties and dual keys, those sorts of things. We really just need to make sure you understand about these types of properties, and they're not for everybody. So it is really just key to make sure you're getting the right advice and the right property. So this is where Propellor are really great and can offer this good advice as well for you. But I think that's it for me at this stage. If there's any questions, we can ask them now or at the end of the session.
I think you brought up a really good point there, Brenda, as well. When you're looking at investment property and to decide what makes a good investment. And actually that can be quite different depending on your own personal situation or your financial situation. And so looking at what makes, first of all, good investment property, we only look at brand new or off the plan, brick and tile, concrete block, tilt slab, good solid builds. Now, with a brand new property, of course, Brenda's just shown you that there's at the moment a very good rate. It's a floating rate for a new build, but also with a new build, it is only 20% deposit. You hold it for, you only need to hold it for 5 years before, if you sell it for the bright line, which means that you don't pay tax on the gosh, isn't it? And on the profit, profit. I should know the word profit. You don't pay tax on the profit. With an older build, of course, you've got to wait 10 years. So when we look at what we want to achieve for you as a client, it comes down to understanding that this is a business and what is the exit strategy for you? What is the short, medium, and long-term goals that we need to achieve for you specifically? So you may not see the house and land packages that we have because it's not right for what we want to achieve. Having said that, how we look at those house and land packages and when we're dealing with developers, it's still the same. It's still 10% holding deposit until settlement, totally turnkey. And the price that you pay today, no matter what happens in the market, is the price that you settle on. So brand new, brick and tile. Now, it can be an apartment, it can be a unit, it can be a townhouse, or it can be a house and land. The key is to feel confident that whatever bank that you go to is going to be able to help you with that loan. And Brenda, we've had a few situations, haven't we, where well, you have, I think, particularly not with Propellor clients, where clients have come to you, they've seen an investment property they like, but the profile just doesn't work for their own banks or for a number of banks.
Yeah, there's a huge variance at the banks with apartment sizes, for example. So, I know where the apartment will work best at which main bank, but as you say, it's just about explaining to people, really, if it's a 20 square meter apartment, that it's really non-standard, and it's going to mean you're going to need to just top up and use equity in your own home, and you're not going to be able to give the bank that security. So it's just, all these risks need to be explained, and that's why you recommend standard size apartments, not really tiny ones.
No, because it's also about the on-sell. Remember this too. I always say that life is a chess game, but so is getting investment property, because we're not just looking at today, we're looking at the next 5 years and 10 years. So for instance, if you've got a $500,000 mortgage on your own home, we may look at, okay, over 10 years, if a property doesn't double for 12 years, as in our cash flows, you spend $650,000 on an investment property today. It's at a good size, so that most of the banks, or all of the banks, will look at this property. You sell it in 10 years' time, and there's 500,000 potential capital gain. You sell it after 5 years, and there's potentially 250,000. There is half of your mortgage gone. So think of it this way. When I show clients the sorted calculator, for instance, and they see how much they're paying over 20 years, what difference does it make? It puts it into perspective that if you're having to top up a property by $100 a week for the next 5 years, how much are you actually saving if you sell that investment property and pay off half of your mortgage in 5 years' time? So you've now got half the mortgage, and you don't have the same amount of interest that you're taking care of. So it's so the profile of the property for you is very important, and the ability to on-sell that property. So it's not just about how it looks and the size. It's what is happening in that area today and in the future that's going to drive the demand for rental and also drive the demand for sales. So let's just bring in Martin now, just to talk about. Hi, Martin.
G'day, how are you?
Good. So we've had over, particularly lately, a couple of different sorts of brand new properties, and they've each had different tax implications, but each of them have given our clients something quite special. So I'm thinking, for instance, about those, first of all, those brand new properties that have got social housing and are giving our clients a really, I think the purchase price 1.3 million, but getting a net return of 67,000 or just over a year, for instance. So if, and then of course you've got the brand new properties at the moment, and there's different tax implications. So let's just give us an example, say, of an average brand new property.
Well, there has been a lot of changes in the situation recently with regard to tax. With a brand new property, they have been exempt from a lot of these changes. So for a brand new property, you're going to be able to deduct the interest for 20 years. Whereas if you've got an existing property, you can't, unfortunately. And any property that was around when the rules changed, you're reducing down to zero over the next few years.
So what does that actually mean? So let's put this in layman's terms.
Yeah.
So an older property now is, the definition of an older property now is something that is...
Okay, so we've got a definition of a new build. A new build is something that was received its code of compliance date, which is basically when it's ready to go, on or after the 27th of March 2021. Now, that definition is really important because not only are the bright line test periods changing, the interest deductibility is changing. So just to give you an example of an existing property, so it's not a new build. If you had a property that, say, was in a break-even position under the old rules, which means it wasn't making any profit, wasn't making any loss, it was just basically came to zero. And in that particular property, you happen to be paying $21,000 worth of interest each year, which isn't unheard of. Under the old rules, you'd be paying So you wouldn't be paying any tax at all. But under the new rules, you'd be paying approximately $7,000 a year, but still not actually making a profit. So it's a big change, and it really means that new builds are far more, far better to invest in for the fact that you can deduct that interest, because you won't get that tax bill for 20 years.
So we are actually starting to see this now with some of our clients, and I'll give you an example. And this is one of the clients that is one of your clients as well,
Yeah.
Martin. So a client bought property 5 years ago, 2 properties from us, and now, so they're only 5 years old, but under this new rule of being 5 years old, they're now both liable for, they both have tax obligations. So potentially our client had tax obligations of what?
I think for that particular client, it was going to be about $14,000 a year.
For each of those properties?
No, for the overall.
Okay. So what we decided to do, and this is part of the strategy that we had for the client anyway, because first of all, we wanted to build up that equity. So over 5 years, these 2 properties have given our clients over $900,000 in equity and potential capital gain. So the next stage now with them is to sell those properties. And they've had them long enough, I think 5 to 7 years. I mean, when they purchased them, what was the bright line then?
When they purchased them, they were actually in the 2-year bright line test. So that has expired. And that is one of the things we've got to be really careful about when we're making these changes, to actually make sure that bright line period has expired. So we don't pay any tax at the end of the day.
So by selling those 2 properties, taking that capital gain, the next thing that we're doing with those clients is they're putting 20% cash deposit onto new properties, which makes them almost cash flow neutral. They're paying off their home mortgage, and they're doing up their beach house. And with new property now, as you were saying, Martin, because it's now under these new rules and within that time period, it's now considered brand new. It's considered new for 20 years. So there is no tax obligations. And if they on-sold those properties to another purchaser, there wouldn't be any tax obligations as well. Is that correct as far as?
Yeah, that's correct. So the 20 years goes with the property itself. So you can change to a new owner, and the new owner would get the remaining part of that 20 years.
Great. So it comes back to it's quite it surprises me sometimes when I've spoken to property investor associations with investors that have got 5 or 6 properties, or multiple properties. First of all, that they've still got their mortgage on their own home, and secondly, that they're not aware of what those tax implications are, but also they don't have their exit strategy. So this is where we're now sort of saying, for our clients that have had property with us, that bought property 5, 6 years ago or 7 years ago, and they've got that capital gain. Now let's look at doing what we've always said, which is to sell those properties, pay off their home mortgage, and now work towards that passive income that we were wanting to achieve. So it's been a 2-stage process. But of course, if you're paying $3,000 or $4,000 a month in mortgage on your home, and principal and interest, it is going to be very difficult to be able to, as we said, look above the parapet, to be able to get something, to look at investment property and topping it up, to get to the next stage, which is that passive income that we all require. So just on with that, Martin, so let's just go, and Brenda, back to older property and just reiterate. So the deposit on older property, Brenda, so the deposit on older property is 40, can be up to 50%.
Yep, generally speaking, at the main banks, 40%. And, you know, we want to be at main banks really, because otherwise interest rates are even higher and cash flow is even worse. So, yeah, 40% on existing rental properties, residential.
Right. And so do the banks, one of the things that we're also finding with older properties, that under the new healthy homes requirements, that older properties can cost up to 30,000, 40,000 to get to make them compliant. One of the questions I was going to ask you, and I'm genuinely interested in knowing, when you're borrowing for an older property, do the banks want to know whether they're healthy home compliant? Can you borrow more to take care of that, you know, to get a property compliant?
Yep. So generally they don't ask if the property's already compliant, but if I present them with a customer who owns a lot of properties, you know 10 properties, for example, they would probably ask if they were all healthy home compliant or not. The banks are offering specials to help people get the homes compliant, and they are offering very cheap interest rates, or even 0% interest rates for some cases over a very short period, like it needs to be paid off in 5 years. So, but they do offer help for people to get your rental properties up to the healthy home standards.
Right.
But it is a cost, you know, and even if it is something to consider though, and everyone's in that boat who does own existing properties.
Yeah. And that's another reason why. I mean, it's a bit of a minefield. So why brand new property is more attractive. And I always talk about culling the herd. We shouldn't feel this thing about holding on to investment properties. They're vehicles to achieve certain things. So if we need to sell some to achieve something, then we should be doing that, because that is part of this business of property investment. Martin, just with one of the questions I wanted to ask you as well, so that if a client was looking at selling a property within that bright line time frame, what sort of what sort of tax implications does that offer?
Well, yeah, there's a couple of things there. First of all, you will be able, if there's any losses carried forward on that property, you would be able to offset against any bright line test gain. But second of all, especially if the property's been held for just a few years, maybe 3 years, there will be quite a considerable capital gain on that. And at the moment, if your income goes up over 180,000, then you will be paying 39 cents on that in the dollar. So right. It is getting quite expensive at that point. And often when I'm talking to clients, we're just weighing up whether, hey, look, can we wait another year and sell it then and not pay any tax? Or do we have to sell it now?
That's right. And so with an older property, that's 10 years that you've got to wait, whereas with a brand new, it's 5. Sorry, James, you've got your hand up for a question.
Yes, I've got a question from Andrew. There are new risks now with new builds, rising material costs, supply chain delays and defaulting builders and the like. How does Propellor select the developers to mitigate these risks?
Great question. Great question. Well, one of the things that we do, even though we hold a license to sell real estate, we're not real estate agents. We consider ourselves to be property strategists. And so when we're brought property to us, we don't accept most of it that comes in. So our due diligence includes the following. Who is the developer? What has he built before? What are his fixtures and fittings like? What are his, where does he get his finance from? Does he have the finance? Does he have to sell so many before finance is drawn down? So these are part of the questions that we ask. And in one instance, I actually asked a developer to see their bank statements to see that the money had come in. However, there's the other part of that, which is the sale and purchase agreement. Now, I won't deal with a developer that does not put in a number of things to protect my clients. One of those is the fact that there is nothing in the contracts that allow that developer to claw back anything if the cost of the build goes up. So when I say that it's a fixed price, it's a fixed price. You know exactly what you're going to pay. Now, another issue which is and that's been in the press is the sunset clause. Now, a sunset clause is it's a clause where it says at a certain date, if the property isn't built, then the developer can take back that property. You'll get your deposit back, but you'll lose any potential capital gain, if you like, but it's there for their benefit. So what we've seen with a couple of unscrupulous developers, and it comes into, but in a way, we say unscrupulous, but you know, if a developer is losing money, and he's trying to save his business, he will draw out the build time for as long as possible till it gets to that sunset date. And then he can say, right, I'm cancelling the contract, here's your deposit back. So he's used your deposit with the banks to get that build underway and get the funds from the bank. He gives you back your deposit. So you haven't lost anything as far as your deposit's concerned, but you have lost because you've lost potential capital gain. Now, we insist that we have a clause, that sunset date, and that sunset clause is purely for the benefit of our purchaser. If our purchaser decides not to go ahead, then they get their deposit back. However, at the moment, of course, and for many years, the longer it takes to build, the more the value of the property goes up. And think of it this way: if you were to settle on a property today that completed today and you had to top it up by $100 a week, so be it. But if there was delays for another 6 months because materials have difficulty coming in or for whatever reason, you are enjoying that 6 months capital growth just as you would do if you'd settled on that property without any extra outgoings. So we're able to do that, as I said, because of our buying power on behalf of our clients. And if a developer won't change the contracts for us and for our clients, we won't work with them. If you went in and you spoke to a developer, they'll only see you once, and more than likely you wouldn't get that same deal because it doesn't mean anything to them. But so we tend to work with, in the different areas of New Zealand, we get new developers, but a lot of the developers that we've worked with now for 5, 10, and in one instance, even 15 years. We may not actually recommend all the developments they do for our clients because they may not be right, but certainly on the ones that we have worked with them on previously, we know how they get their funding, we know what the finishes are like, and the sale and purchase agreements are there for the benefit of our clients. And this is one of the things that I say to our clients: you don't know what you don't know. And it's very difficult for you, if you go to a developer direct, to know the right things to ask. Now, one of the things that we're seeing as well with the change in this CCCFA, with the new regulations for lending, even though it's relaxing at the moment, we've still got investors or purchasers that aren't able to settle, and so that there is those issues going forward as well, which we try and work with our clients. So whether we put it back onto our stock list, or we work with a client and Brenda to find solutions in the short term. So Brenda, if you could come back on, because I'd just like to talk about two scenarios with you. One is a client of ours who had pre-approval, and because of the CCCFA, they no longer qualified when it came to settlement. But you looked at other options. So can we just talk about some of those other options and how they can be used strategically?
Sure. And just with the CCCFA, you know, they have relaxed the rules a little bit more. Just quickly, like, for example, if you put 8 or 10% into KiwiSaver, they're only going to work on 3%. So there has been some changes there. I think they're not really looking at all your spending on coffee and eating out so much, because all of it's discretionary. So they're being really sensible about it now. But we have had situation where when the rules first come out in December, they were being super strict. I had one person who spent quite a lot of money on Uber Eats each month, and the bank said, well, sorry, it doesn't serve us. But, you know, he had amazing amounts of money in his accounts at all times. It was all very good. And I just knew we'd make that work. But we did move to a non-bank option. But I've got this client back at a main bank again now. It was a temporary thing, you know, while these rules, you know, just sort of relaxed a little bit, I guess, and the banks now know what they're doing. It was an example of what we did. Yes, other examples for people who, you know, I keep in touch with everyone throughout the build, and well before it's complete, we are checking to see if there's been any changes, you know, where we can get it approved. And, you know, as you said earlier, Nikki, you don't allow people to sign up on contracts that can't on-sell them. And, you know, on a number of situations, we've come back to you saying the client's changed their mind, or there's been a different situation for them and they want to on-sell, and you've always been amazing. And I just don't think other people offer that service for people. And, you know, touch wood, we've never had anyone not settle in the 12 years. So
no.
Nobody has not settled or got their deposit back, or, you know, lost money. So, you know, it's a credit to Propellor.
Thank you so much. And just on that, you called me the other day about a client of yours that went direct to a developer. And this is where we look at some of the issues that perhaps purchasers don't realise. Now, if you want to go through that scenario as well, that their situation had changed, and it's not a great ending, isn't it? Of the story, really.
No, well, a client I've had recently, in the fine print, you know, these contracts are 60 pages. The clause to on sale was not there, and the developer didn't allow an on sale. It hasn't yet come up for settlement, but, you know, we are looking at some other options. But it's just an example of how you make sure these contracts are bulletproof and the clients can on sell or change the and or nominee to allow a friend or something to help. But, you know, it is a minefield out there, as you say, and there is, you know, lots of risks. But, you know, your contracts are pretty tight, and, you know, hopefully, you know, it just makes people feel a lot more at ease.
Yeah, and the other thing that we are seeing as well, when we do cash flow, say for a year, you know, that was a year ago, and we put those together based on what was happening at that stage. One of the things that we do as well with interest rates that are going, that have been going up, and it means that a lot of properties, because remember, our investors, 90% of these investors, or 95, are using equity in their home to guarantee the deposit for this investment property. So we're talking about 100%. It's 100% borrowing, and so yes, the days when it was cash flow positive, fantastic, but in all reality, to get something for nothing isn't something that we should expect. But what we're seeing is that especially with the house and land, where the property may now be $800,000 or $900,000, particularly in Christchurch. But because prices have gone up so quickly, rents have not met that, because those properties haven't been built yet. And so when we put together cash flows, we're using rental appraisals that are on existing properties that when they were built were $500,000 or $600,000. So we will see that change. But it's meaning that some of these properties are now, a top up of $200 a week. Now, I saw that when interest rates were 10%, didn't stop our investors purchasing them. But Brenda, one of the things that we do as well is how we, and this is what we do with Brenda, we look at how we can reduce that by putting in place a buffer. So if you just want to go through how you work with that with the banks.
Yeah, sure. So it's really treated like its own little business. It's not part of your main account. It is a separate rental account that I set up for this rental property. And I like to put like a facility on there to take care of costs, because there is going to be like insurance rates, a solicitor to pay, accountant's fee at some point in the year. It might take a few weeks to find a tenant initially. So there are costs, and also the deposit loan costs for the 6 to 12 months of when the property is going to be ready. So I set up like a revolving credit, like an overdraft on the rental account. It's all tax deductible, and it just means you're not having to come up with the money for those costs or any fees or anything. Some people choose to furnish apartments or small townhouses, again, allow for that kind of thing as well. So it's all kept separate, like a little business, its own business. And I set up a revolving credit on there to cover all the costs, so you're not having to find the money yourselves.
And also one of the things that we do is that we put in a contingency amount, a buffer as well. So if you just want to go through and how it reduces the top up on a property.
Yeah, so it just means that we can allow extra money in here in the revolving credit to cover the top ups. So you're not having to cover the $200 a week. We actually do borrow the money, but it's a revolving credit facility and you're only charged for what you owe. The rent also goes into that account, so that helps reduce it down. But it's all factored in, and we like to allow for a good, I try and ask for $20,000 to allow for future years. Could be anything, and it could last for 5 years, or we can just relook at it as we go.
One of the things that we do in our cash flows, our even though we show interest rates at say 5.5%, our view is that, and we're seeing it now, that interest rates are potentially going down, but we're thinking, well, let's allow 3 years for this. So if the top up is like $200 a week, and Brenda has got this revolving credit, or she's got this buffer of $20,000, we may show it in the cash flows that $20,000 over 3 years or 5 years. And so that can potentially reduce your top up from $200 a week down to, say, let's just say you got that over 3 years or 5 years. If you're looking at selling that property to pay off some of your mortgage, that means that could go down to $100 a week. Now, that is quite palatable if you're thinking, okay, so it's $5,200 a year that you're topping up that property for 5 years, so that's what, $25,000, but you're reducing your $500,000 mortgage by half. which means that your outgoings on your mortgage is less, and you're going to have less time in which to have that paid off, and not the 20 years as we saw in that sorted calculator. So it is about the fact that it's a business. The other thing you brought up was furniture. One of the things that Brenda does, furniture can give you an extra $50, up to $50 a week extra in rental, which helps with that not having as much as a top up. So Brenda borrows that. You don't have to come up with that. Martin, whilst you're there, can you just give us the latest on furniture and how that impacts on tax?
Oh yeah, we can claim depreciation on the furniture, which will reduce any tax liabilities either this year or in the future, because any losses would carry forward.
Right.
So yeah, there hasn't been a lot of change in that space. It's pretty much as it has been.
Right. Okay. So we've thanks for that, Martin. So we've looked at some of the traps for investors. One is, first of all, understanding what your exit strategy is, understanding what you want to achieve, because that then gives you an idea of the profile of the sort of property that's going to work for you. You don't necessarily need $1 million property. It could be 650,000, because we're looking at your borrowing capacity, the top up that you may need to do, but also how that works with reducing your mortgage, for instance, or what the rental may be in the future for that passive income. Looking at the sale and purchase agreement, looking at how you can be protected if your situation changes, or to protect you so that if you've got a pre-approval today for say 650,000 or 700,000, that you're able to get that when that property does settle. And as we said, we don't walk away from our clients in that scenario. If your situation does change, we look at how that property can be sold on your behalf. And interestingly enough, we do get this where coming close to settlement, a client may have bought a property a year ago, and we had this recently. We get a new valuation. We're able to on-sell at valuation. None of the properties that we recommend to our clients is ever any more than their value. But not only do our clients get their deposit back, the original clients, but they've also enjoyed some capital gain in that time whilst their 10% deposit's been sitting there. So clients of ours recently got their deposit back and an extra 70,000, and they hadn't even settled on the property. But we could on-sell that because of our ability to have that to negotiate with the developer to be able to do it, because the developer knows that we are not going to compromise the integrity or the value of that whole development by doing a fire sale or trying to get rid of that property at whatever cost, because it's imperative that we maintain the integrity and the value of that development being set up in the right way. So why we say brand new property, you're going to not have maintenance and repair issues. You're not going to have the issue of making it healthy home compliant. You're going to get better quality tenants, and you're going to get higher rental returns with brand new property, and you can sell it in 5 years' time if you have to, and not pay tax on the profit of that. So we've gone on a bit. Let's now just bring back the panel, Martin, Brenda, and James, and any questions that you may have for us. Please don't hesitate to ask. But just to finish, on this, I come back to how we started. Look at history, look at the fact that for most of us, there is no other way to get to the next stage in our lives other than investment property. And so how do we then structure this to work in this environment and to take us forward to the future? And I'm going to paraphrase Warren Buffett. I'm going to really paraphrase him, while the sheep are heading in one direction, that's when you head in another direction. Sorry, James, so we're going to start the question and answered. And if you want to have a meeting with any of our senior consultants, that meeting is completely free. And it is exciting because we're going to put together a strategy for you. Most people don't have that. We're going to put it in black and white, how you can achieve certain things. And why not take that opportunity? So, sorry, James, you've got a question. We can see your face if you like. We don't mind.
Of course. Yeah. So just to speak very briefly to that, just prior to the query. So I will leave my immediate details for those who are wishing to have a quick chat and speak to more about the details. I work very strongly alongside the consultant team, so I'll leave that. But we've got a question from Richard De Jong saying, hi, do the banks have an issue with older borrowers, as I am 55 years of age, going to build and rent a home until I retire there? Many thanks. That's from Richard.
I'll help answer that. So, yeah, look, anyone who is over probably the age of 50, some banks are a little bit, fussy on the age. But generally speaking, if you're working, got good income, good equity in your home, everything's good. I'm telling banks that, you're working to 65. You can sell the property in 5 years when you don't have the bright line test issues, or you'll sell before you retire is generally what I'm saying, and I'm finding I'm getting approvals through, no problem.
Awesome. And we've got one, this is for potentially could be for anybody on the panel, but it's from Abhishek saying, kia ora, what's the minimum deposit we need to have a meaningful first chat with you from a first home buyer? What's a good start point?
We first home buyers, it's a bit different. We don't really deal with first home buyers because you're looking at something. What you're looking for is quite different. You're looking for something that you're going to want to live in, that's close to your work or family or schools. We, as a company, are looking for investment opportunities. So our properties and our due diligence is all about on that, getting that capital growth and the right sort of rentals. But having said that, Brenda could help you. So Brenda.
Yeah, sure, absolutely. So I can help first-time buyers as well. So just feel free to get in touch afterwards. But just quickly, you can buy if you meet criteria with a 5% deposit. But just feel free to get in touch, and I'm happy to talk about it later.
Yeah, I'll contact you directly through this, Abhishek, to give details. We've got one question here from a new one from Nick Sharma. Do you think in the current market we still have the ability to buy cash flow positive property? Realistically,
well, yeah, that's a difficult one. When we put a buffer in, some of them are cash flow positive for a few years. The cash flows that we put together are quite conservative. And so we're looking at, even though the properties may be a year away, we're looking at rentals today, we're looking at interest rates today. And so it is a lot more difficult because remember, it's 100% borrowing for most clients. Now, if you've got a cash deposit, yes, you could be cash flow positive. On the new build rate that there is at the moment, whilst that's still available, we've got property that is cash flow positive. Yes, we do. But that new build rate may not last for any more than a year.
Awesome. We've got just one final sort of follow-up question from Barry, who had one of our initial questions. Can you speak to in more detail how you come up with the 6.5% to use in your modelling? Because I'm an engineer and quite inclined to look into more detail. Barry.
Right. Okay. Thanks, Barry. Well, as we were saying that since 1991, for instance, 1991, 1992, there's actually been a 7% growth per annum. So by us saying 6.5%, that is saying that the property doesn't double for 12 years. However, you don't have to, if you don't feel comfortable with that, we also have in our cash flows other options. So we go 5%, 4% down to 3% where the property doesn't double for 20 years. But as I said at the start as well, when you're looking at a new build and what it's costing for a new build, and at the moment, you know, with cost of materials going up by 21%, one of the developers that we were dealing with in the past, he had a major development in central Auckland, an apartment block, and he was saying, for instance, the cost of through the build from the council for traffic management. When he started 10 years ago, it was $21,000 to do that. Now it's $250,000. So we've seen history has shown that it's a lot more aggressive than what we show in our cash flows. But we come back to and that's when the cost of living was at 2.5%. Now with the cost of living being at 6.7%, where everything is going up by more than that, then we can also then look at justifying that cost of building. And I don't see the cost of building going down because we have no control in this country on the materials that are coming in.
Awesome. And we've got a new one from Steve Vincent, obviously in terms more of protection side of things. If one of your developers or goes under, also has difficult times, what happens? How are your clients protected? Has this ever happened before for Propellor, and how was that dealt with from Steve?
Well, first of all, a client's deposit is held in a solicitor's trust account. So the developer doesn't get hold of that deposit at all, cannot utilize that deposit unless there's a special request within the agreement. But 9 times out of 10, it's held in a solicitor's trust account, can't be touched. So worst case scenario is you get that deposit back, but you know you've potentially missed out on some capital gains. So more so, we haven't had any clients that have lost deposits because the developers just don't get their hands on the deposits at all. But of course, with how it is at the moment, with with the fact that property prices are going up and there is that capital growth, that's why we now spend more time, especially over the last year and a half or 2 years, ensuring that the developer does have the funding in place and where that funding is coming from. Only because we want our clients to enjoy that capital gain.
Fantastic. I think that just about wraps the remainder of the questions, Nikki. I will, to those who have put into the chat, obviously Steve, Abhishek, Richard, and Barry, and Nick Sharma, I'll reach out to all of you separately. But for those obviously still live, I'll leave my details in the chat. Obviously, I work again very strongly with the consultants and can speak further to these details and put you in the right place. But I think that about concludes all the queries. Nikki, have you got any sort of final commentary from anybody?
No, I haven't. Property is still the solution for most of us. It's just how it's put together, and it's handled as a business. But thank you so much. It's after 13 years, I've got to say that it's so wonderful to see clients come back, and for us to be part of the strategy going forward and seeing that come to fruition. That has given me personally a great deal of satisfaction. And we've had Martin that's helped our clients that have been beside us for a number of years, and of course Brenda as well. So with our consultants and our team, it's a very consistent and solid team, all with experience, either in banking or in mortgage brokering, but that can bring something to the party. So thank you so much, everyone, for this evening, and thank you, everyone in the panel who has joined us. Thanks a lot.
And I'll continue to leave this chat open just for the last few questions, and yeah, that'll be the end of the event, and we'll look forward to speaking to you soon.
Thank you. Thanks a lot. Bye.
Bye.